Hi there, welcome back to the channel. I'm Michael and today we're going to take a closer look at commodity markets, specifically focusing on the concept of backwardation and contango in the oil markets. Despite a recent surge in oil prices due to an unexpected production cut by OPEC, oil traders remain skeptical about a sustained increase in prices. Oil future contracts are indicating a potential retreat in prices after the initial shock. This is illustrated by the fact that December futures are now trading at lower levels compared to current prices. Typically, you would interpret this as a bearish channel. Why invest in oil stocks today if oil prices are expected to decline by the end of the year? However, this current trading pattern, known as backwardation, has historically been interpreted as a bullish signal, which could potentially result in further gains for oil prices and stocks. Backwardation refers to a situation in futures trading where the near-term futures contracts are priced higher than the future contracts with longer expiration dates. In other words, it's a market condition where the future prices decrease as the delivery dates approaches. This is contrary to the more typical condition called Contango, where futures contracts with longer expiration dates are priced higher than the near-term contracts. Backwardation and contango can occur in commodity markets such as oil, gas, or agricultural products, and are often seen as bullish signals. They suggest that there's currently a higher demand for the physical commodity, leading to higher prices for near-term delivery compared to the expectation of lower demand in the future. This can incentivize traders to buy the commodity in the near term and sell it in the future, potentially resulting in increased prices and profits. Backwardation can also incentivize oil producers to limit output as they would receive lower payments in the future. By reducing supply, most producers have done over the past 2 years, oil prices are expected to remain strong. Now, let's take a closer look at some of the typical features of commodity markets that differentiate them from other types of financial markets. Unlike financial markets, where transactions are typically settled in cash, commodity markets often involve the physical delivery of the underlying asset. Buyers and sellers may enter into futures contracts which require the actual delivery or receipt of the commodity at a specified time and location. Commodity markets are highly sensitive to supply and demand factors, geopolitical events, weather conditions, and other external factors that can impact commodity prices. As a result, commodity prices can be highly volatile with rapid price fluctuations. Seasonal demand. Commodity markets often exhibit seasonal demand patterns where the demand for certain commodities may vary based on factors such as weather, crop cycles, or industrial demand patterns. For example, agricultural commodities may experience higher demand during planting or harvesting seasons, while energy commodities may be influenced by factors like seasonal changes in demand for heating or cooling. Commodity markets are also influenced by global factors, including international trade policies, geopolitical tensions, and macroeconomic trends. Changes in global supply and demand dynamics, currency fluctuations, and trade policies of major economies can impact commodity prices and market sentiment. Commodity markets involve the physical storage and transportation of commodities, which can add additional costs and logistical considerations to trading. Factors such as transportation infrastructure, warehousing capacity, and storage costs can impact the supply and demand dynamics of commodity markets. Commodity markets also often serve as a platform for price discovery, where the forces of supply and demand interact to determine commodity prices. The price discovery process in commodity markets can be influenced by various factors, including fundamental analysis, technical analysis, and market sentiment. Commodity markets are often used for hedging and risk management purposes by producers, consumers, and traders alike. Participants in commodity markets may use futures contracts, options, or other derivative instruments to manage price risk associated with changes in commodity prices. I hope you've enjoyed this little intro in the commodity markets. If you're interested in learning more about economic concepts or my daily analysis of the US stock markets, please consider subscribing to this young channel. It's a huge support and will not cost you a thing. Thank you for watching. We'll be back tomorrow.